You are listening to Charting Wealth's weekly review and forecast for the week beginning Monday, the 25th of April, 2016. As we look at the charts, we will start with the weekly chart. This is the way we're going to do it. We always do it. We review the weekly chart, then the daily chart on our three big indexes and gold. The indexes are the total market, the S&P 500, and the Qs, which is the NASDAQ 100. We'll then talk about what moved the market over the past week and what's going to be happening in the coming week and what might affect things. So let's jump right in. IYY is an exchange-traded fund put out by iShares. It tracks the entire market, and we see the market started to move up substantially after the beginning of the year and huge down moves in January. And about mid-February, well, about the 19th of February, the week ending then, so it started mid-February, we started seeing the market boom up, and it has recovered all of those losses from the beginning of the year. We literally have up green candles since the week ending the 19th of February. The past week also ended up. Actually, on Friday, the total market itself was up 0.04%. We had another big up candle. We do see the derivative oscillator losing a bit of its energy, but the MACD is well over the signal line. We've continued to have up movements. For those of you who are learning how to actually invest as opposed to trading, that is shorter term thinking, investing's longer term thinking, you can see that if you can read a stock chart and can see when it starts to move over, when we've got nice clean up movements, could have gotten in somewhere. We'll even look at when the market moved over. If you had jumped in somewhere around the crossover date on the 4th of March, you had the market open somewhere around $95. The high that week was $100. The market since then moved up 1, 2, 3, 4, 5, 6, 7 weeks since then. And as the market ended on Friday, it closed at 104. It was a high of 105, a low of 102. So we've seen nice clean up movements, even if you just did the safest thing and entered in when we had that crossover. So again, I urge you, whether you're learning to trade or invest, pay attention to these charts. Join us at least for this broadcast. And I would encourage you to join us on every day's broadcast and practice trading. So we ended up, if we want to look at our daily chart, we can see what the market did during the course of the week. Of course, the market opened on the 18th. It was up move for 3 days and then started moving down, has not quite crossed over on the daily chart. Derivative oscillators losing some of its energy that built up from the 18th until the 20th, and then Thursday and Friday were down movements on our daily chart. And again, we use the Heikin Ashi, the average pace type of candlestick charting, different from your standard candlestick of high-low open close. We're above still the 2-day trend line on that daily chart. So we have in the total market a continued strong up movement, although we could be topping out just looking at the daily chart, but we're not there yet. So we continue to call both of those up moves. Now we're going to drop back to our weekly chart. We're going to take a look at the S&P 500. Again, very similar to the total market. It started moving up around the 19th of February, had a crossover the week ending the 4th of March, and has continued to move up strongly. The high that 4th of March was $100, and we see, oh, I'm sorry, I did not change over. There we go. I started looking at that. It is exactly what I said before. Did cross over going up on the 4th. The high that week was 201, and the market closed at a high this last week of 210.92, and its low was 205.38. So we've continued to see good, strong up movement. The market still is green when it comes to derivative oscillator, and we still have a nice separation between the MACD and the average, the exponential moving average, what we call our signal line. Now, if we drop back to our daily chart and take a look at what's been going on over the last week, we see on the 18th, again, somewhat similar to how the total market looked. And like we always say, remember the S&P 500 or 500 big volume companies. They don't always track exactly the total market, but many times can look similar. Lots of strong up movement on Monday, Tuesday, and Wednesday. So much movement that actually is above our Bollinger Bands. The Bollinger Bands are volatility bands, are represented on our chart by blue dashes, and we had movement above the Bollinger Bands those first 3 days. And then a lot of indecision on Thursday, and then a down move on Friday. Still hasn't crossed over yet going down, but the derivative oscillator's lost a lot of its energy. So that is where we are as far as the S&P goes. No crossover yet on the daily chart. Still strong up moves on the weekly chart. For those of you particularly who are looking to learn how to use these charts to invest in a much longer term than just the regular 2-day and half-day chart that we use on our daily review. Now we're going to go back to the weekly chart and take a look at the Qs. The Qs, which represents the NASDAQ 100, down strong at the end of the week, 1.51%. We had the Qs started moving up back on the 19th of February. The crossover occurred about a week later than the S&P 500 and the total market around the 11th, and continued to move up strongly since then until the past week, which is pretty much ended with a spinning top showing indecision. Has the Qs topped out? We don't know yet. We'll continue to watch. Derivative oscillators lost some of its energy. We've seen a kink over in the MACD, getting closer to the signal line, but still a lot's going to have to happen for that to roll all the way over on the weekly chart. We'll just continue to watch those things. Now, if we look at the daily chart, what do we see? We see that the daily chart on the 18th, there was up movement in the 19th, and then what really happened is the Qs slid sideways, the NASDAQ slid sideways on Wednesday and Thursday, and then dropped hard on Friday. Like we said, down 1.51%. We had a crossover actually on the daily chart back on the 19th, Tuesday, and we had the derivative oscillator plunge over on Friday. So that is where we are. The, again, daily down strong. But when we look at the weekly chart on the NASDAQ 100, still don't have a crossover yet going down, but we've seen some of that momentum really shave off over the course of the last week. But 1 week does not make a change in the charts, does it? That's where we are on our 3 indexes. Now, lastly, before we get into the news, we're going to look at gold. The weekly chart shows us in gold, still not crossed over yet going down. Gold crossed over going up back on the week ending on the 8th of January, and rose up pretty strongly until topping out somewhere around the 11th of March, and then rolled down, slid sideways sometime starting around the 1st of April. And we have somewhat of a spinning top showing us some indecision. Again, hasn't crossed over going down yet, although the derivative oscillator has flipped over on our weekly chart. So we'll continue to watch gold and see if that up movement has truly come to an end. It has bled off all that upward energy, but it still hasn't dropped below, as far as the close at the end of this last week, where the market started moving up on the week of the March the 11th of 2016. So again, hasn't lost a considerable amount of energy, or at least price, and we'll see how much that energy dissipation is going to rotate the market over and send it down in gold. That's yet to be seen. Well, that is where we are. And let's do, before we jump away from gold, let's just let you see what it did during the course of the week. On the 18th, gold was up a little, huge boom up on the 19th, and then a rotation over on Wednesday, a bit of a stronger up move again on Thursday, and then a rotation over down on Friday, 1.28%. getting really close to crossing over the 2-day trend line on the daily chart, and gold has sort of been slipping sideways. The MACD is not helpful for being able to read the gold chart when it's up and down, up and down, up and down, slipping sideways without considerable movement above prior or considerably down on prior candles. The MACD is not good for a sideways slipping market. It is good when you've got a trending market, so it makes it difficult to make any good calls on gold. We're just waiting for gold to sort itself out. We had a great chart. Our 4-hour chart was a great chart back before Christmas last year, and since then, with so much sideways slippage in the market, it has not been the kind of chart that we had wanted it to be. But we'll continue to watch. Again, gold just crossed over going down on the daily chart, and as far as the weekly chart goes, still in a confirmed up move, but that could be ending. Now let's talk a little bit about, before we close out this broadcast, what actually affected the market over the course of the week that ended the 22nd of April. We saw oil rallied for the week. That was interesting because we actually had an oil production freeze talk go nowhere when Saudi Arabia refused to freeze oil production without Iran's participation. So we saw oil rally on that. We ended up seeing the emerging nations cut their interest rates. We saw the European Central Bank hold policy rates unchanged. We saw the post-January stocks rebound in China. They had a very difficult and shaky start, but they have rebounded, have returned about 23% or so since their lows in mid-February. We've also seen U.S. jobless claims have fallen again to their lowest levels, this time since 1973. Of new claims, there were only 247,000. The consensus was somewhere around 265,000. And again, although that's the lowest level since 1971, with the size of the market being a lot larger, it's than it was 40 years ago. It is showing us that, at least as far as what's reported as unemployment to the government, is down. The European Central Bank held their key interest rate unchanged. Like we said just a minute ago, we see emerging nations such as Taiwan, Hungary, Turkey, Indonesia, India, all these different countries lowering their policy interest rates in an attempt to, what they hope will improve slow economic growth. We'll see just how that plays out. Now, when we start looking at what's going to actually affect things in the upcoming week, we need to pay close attention to what's going to be happening on Tuesday and Wednesday in particular. The Federal Open Market Committee is going to be meeting Tuesday and Wednesday. Of course, in this age of free money and worries about tightening federal policy, whether that's going to happen or not, we're just going to have to pay a lot of attention. That can weigh heavily on the market. So be forewarned as we get into this week as to the potential impact of anything that happens during that Fed meeting. Also, what might set the tone for the week is Monday, new home sales are going to be reported in the U.S., followed Tuesday by durable goods orders as the Federal Open Market Committee gets underway. And then on Thursday, U.S. GDP is going to be announced. So those kinds of things throughout the course of this next week can weigh heavily on market sentiment. I cannot tell you how any of those things are going to come out, and even when they do, the impact they're going to have. But just be aware, this is a heavy news week, and it can have heavy impacts on the market. Now, I would encourage you, as always, if you don't have your 2016 Stock Traders Almanac, you need to have that. You need to look at that at the beginning of every week, review it. It is very important for you to have. Those are available at Amazon. That's where I always order mine. I would encourage you to make sure you have the Stock Traders Almanac for 2016. Read it at the beginning of every week, and of course at the beginning of every new month. That is where we are as we wrap up last week, get ready to move into the new week. Again, pay attention to the impact that these meetings of the Fed and these releases of the data can have. It doesn't happen every week, but when this does happen, you just need to be cognizant of that because it can impact positively or negatively the market, and be ready, willing, and able to roll with those punches. Remember, it's the charts that lead us, not the news, but the impact that news has on the charts we need to look for. We love to hear from you. Follow us on Facebook, Twitter, Instagram, YouTube. If you really like what we do, go subscribe to us on iTunes. But even if you don't subscribe to us there, would you do us a favor? If you appreciate the free service we provide every day, and then this once a week weekly review and forecast, go say something nice about us. Give us a 5-star rating. Thank you so much. We always love to hear from you. Go to chartingwealth.com. You can sign up for our daily newsletter, which includes our weekly review and forecast. When you do that, you will get for free a link to our How to Read a Stock Chart video that'll give you lots of good information to figure out what it is we do here every day and to encourage you. In addition, you'll get the layout that we use at Free Stock Charts. Before you try to download that layout, first go to freestockcharts.com, sign up for your free account, then download the overlay that we use, the link, and it will link right into your page and give you the layout we use every day and every week. Thank you so much. We appreciate you joining us from chartingwealth.com.